Time now for our Wall Street Week daily segment. John Goff, he is chairman of Crescent Real Estate and Contango Oil and Gas Company. He joined our David Westin earlier to discuss the impact of higher interest rates on the hotel industry and more. Take a listen.
It's certainly putting a dampening effect on any new competitive product. We have a number of properties underway, one which is about to be completed, which is the Crescent Hotel in Fort Worth, right in the part of the cultural district. That was previously funded, so we're just completing. In fact, we're looking forward to opening it tomorrow. In addition, I have a Canyon Ranch development that's already funded with our strategic partnership with Beachy Properties, the NYSE company run by Ed Petoniak. And we announced that recently, and they are financing our Austin resort development, and it's underway right now. So fortunately, we have all of our projects funded, but to get funding for a new incremental project today would be very difficult.
Let me take the other side of it if I could. There's been some repricing in a lot of real estate because of those higher rates. That's the way the arithmetic works, as I understand it. I understand it may be difficult to get funding, but are there some bargains out there if you can find some funding because some prices have come down?
Absolutely. It's not like the early 90s when I started Crescent, and I would say we were, buying assets by the pound. We were able to buy just extraordinary properties that were newly built at, fractions of what they were built for. Today, there's definitely discounts available, but it's not to the extreme that we saw in the 90s. But I think this is we're entering a period here where there are going to be great properties that will hit a debt wall, so to speak, and we'll be able to acquire some very attractive properties at compelling pricing. I don't think we're going to be stealing anything. I don't think anybody's going to be doing that, but I think there will be compelling pricing. But you have to find the financing. So, we're looking to utilize very low leverage and a lot of, really lean on our equity partners to finance our acquisitions here going forward.
John, give us your thoughts about another big business you're in, which is oil and gas. So where are we right now in the United States in oil and gas? Where's it going? We've seen a couple of big deals, particularly involving shale in the last 2 or 3 weeks.
Yeah, I think there's going to be continued consolidation in the energy sector. Look, I think oil and gas to me is incredibly attractive. And look, I'm all for doing the right things for the environment. But we have not seen peak demand. And those that say that we have are very much uninformed, in my opinion, and aren't looking at the real data. We haven't even seen peak demand in coal. We're woefully underinvested in replacing oil and gas reserves on a global basis. The energy transition is very much misguided, in my opinion. It's based on politics and emotion. It's not based on science and fact. And all we're doing is we're substituting one form of mineral extraction for another. Batteries in and of themselves don't create power. It's the minerals within the battery and the charging of the batteries that really creates the power, much of which is still being generated through oil and gas. And then if you just look at the backdrop of the population on the planet, we're going to add another 2 billion people by 2050, and that's going to be in these places like China, Southeast Asia, India, and Africa. And on a per capita basis, compared to Europe and the United States and Canada and Japan, they use far less per capita of oil and gas, but that's going to change as they aspire to a better way of life. So I don't think we're anywhere close to peak demand. I think we're woefully underinvested on a global basis. I think oil and gas is very attractive. My participation in that sector is primarily through a public company called Crescent Energy, which was formed out of a merger of a smaller company I had public called Contango with all of KKR's energy business, which went under the name Independence. And we closed that roughly a year ago, and very excited about the prospects for this company.
So John, you said that current policy with respect to transition is based more on politics than on science. Let's put you in charge of the whole thing, government, private, everything else. If you're going to do it scientifically, what would you do? I assume you do think there should be some form of transition.
Oh, no doubt there should be a form of transition. But to simply set aside oil and gas as the crux of our economy, the crux of our energy capacity is extremely naive, if not dangerous. So I think if you look at the production of energy and the efficiency of of oil and gas, and the efficiency and the manner in which that's being done, particularly by the more major companies today, it's being done in a far more environmentally sensitive way, as well as when you look at engines and how the technology that has developed engines that burn hydrocarbons, that can also be done in a much more effective way, whether it's hybrids or far more efficient engines. So to toss all this out and go to 100% electric and be reliant upon mining of minerals, which is highly destructive in and of itself to the environment, is, in my opinion, a fool's errand.